Quarmby, he's the head of regional banks research to Asia ex-Japan for Barclays Capital. And you're listening into what Obama had to say. He says he wants a balanced budget here. This is a balanced measure, bipartisan politics. What do you think? Is this the best deal he could have gotten?
I don't know if it's the best deal, Susan, but I think it's a deal that goes a long way to addressing what are not short-term concerns, but medium to longer-term concerns about the overall level of indebtedness within the US economy. I think the amount of debt we've seen the government taking on board has been a bid to try and consolidate debt from the consumer level and the corporate level into the government, and now we're seeing the government take the necessary steps to reduce their deficit and hopefully reduce their debt burden going forward. I think ultimately, from a market's perspective, this is very positive because, as the President said, this goes a long way to reducing the risk of default by the US government.
It does, but it's also very tentative. I mean, we're looking at just $1 trillion in cuts. A lot of these circuit breaker events as well that basically you need bipartisan agreement on. And, you know, that to me seems really tentative. We can't even get this deal through.
I think still a lot of hurdles to meet, but, you know, I think the important thing is they've agreed to an initial round of budget cuts. This gets them out of a lot of trouble in the near term. We're looking probably at 12 months of where they have a bit of an easing on conditions for their own debt and potential downgrades. And I think from a market perspective, that's a decent outcome. Yeah,
that is a decent outcome considering you're seeing this rally across the Asia Pacific. So is it risk back on then?
Yeah, I think to a certain degree. You know, what we're looking at for Asia, we've known the US economy is doing quite poorly. This means that with budget cuts and no tax cuts, you're going to continue to see the US economy probably struggle to deliver any really strong growth or upside. So we're really back to, you know, what's happening domestically, where the strong stories are. And I think Asia's proven itself to be reasonably strong from a domestic standpoint.
That's right. They are looking pretty strong, considering you heard the news today of HSBC trying to sell off 195 branches. And cutting 10,000 jobs, not many of those being in the Asia Pacific.
Correct.
So what does that mean for HSBC's bottom line, and is that the trend for lenders going forward?
Yeah, well, look, let's remember what HSBC is trying to achieve. They had a 58% cost income in the second half of last year. We're forecasting 56 for this half, but the target is 48 to 52. Now, to achieve that, they obviously need to cut costs, and I think as part of the group strategy, they've talked about refocusing on their areas of strength, which is emerging markets and which is our markets here in Asia. Okay. So the sell-down of US branches, the potential reduction of staff that's been reported in the FT are all along the lines of the strategy that Stuart Gulliver outlined a couple of months ago.
Yeah, cost reduction, that's his main focus right now. So what about HSBC as a stock itself, because it hasn't done that well so far this year? It seems like other lenders have jumped ahead. Is it a buy right now in your view?
Near term, it's going to struggle because the big catalyst for earnings to really deliver some upside and some momentum really is rising US rates. And I think with the announcement we've just seen, we're not going to see US rates rise anytime in the immediate future. So for earnings momentum to kick in and for that stock to really do well, we really need to see that, and it doesn't look like that's going to happen near term.
Okay, what would be a surprise number to you? We're expecting $8 billion, I think, in the first half.
Yeah, look, we're a bit below consensus. We've got about 7.7. Market's about 8.3. So, you know, anywhere above 8.3, I think, would be a surprisingly strong number. I think going back to that cost issue, if we do see a cost-to-income ratio in the low 50s, so maybe better than 55%, that would be taken very positively as well.
Okay, that would be taken positively as well. Now, what about local lenders themselves? Because you're talking about you're preferring Hang Seng Bank to BOCK among the local branches. Why is that?
Well, if you go to the issue we've been talking about for a while, which is the very tight liquidity conditions in Hong Kong, I think what you're going to see in these results are that the cost of funds has gone up. Deposit rates have been rising very rapidly. Banks are taking on more time deposits, which are more expensive. Credit growth is slowing. And the RMB businesses, which particularly for Bank of China Hong Kong is very large in terms of deposits, are not yet generating any income. It's all about liabilities, it's all about costs at the moment and building up that deposit base, so they're not generating any income from those revenue streams. So I think you see, particularly for the big stocks you mentioned, Bank of China Hong Kong margin under pressure, credit growth slowing quite a lot. Hang Seng Bank margin, very, very resilient, given it has a much stronger funding base and probably has benefited from some of the repricing of mortgages we've seen.
Okay, Tom, thank you for joining us this morning. We'll see how HSBC does later on today. Tom Quarmby of Bar Caps.